So the market came down on Friday about 1%. Not a terribly big move, but a move nonetheless. And we had been talking the other day about the potential setup for a reversal of trend in the marketplace. And there's reasons that we could probably think that this could continue. And again, one of the most obvious reasons were volatility levels, what we were seeing there. Realized volatility got to very low levels, and even with the rise on Friday, we still are at extremely low levels. And so I would think that if we continue to see headline risk in the marketplace, there's a chance that we could really see volatility begin to move up still. And you can see the same thing with 3-month implied correlations. In fact, when you look at the VIX, it did move all the way up to about 20.8. So again, volatility levels overall are sort of low and depressed and really aren't in a way factoring a lot of the geopolitical risk and certainly the uncertainty around tariffs. The other thing that's going on this week, which is probably just as important, is we're going to start seeing liquidity levels probably get drained a little bit. This is a tax week, and we've seen the Treasury general account come down to some low levels, and that's primarily because the Treasury is not allowed to grow the debt ceiling, so they're basically using the Treasury general account to pay all the bills. Now this week we're going to be getting an influx of cash because it is a tax week, June 15th, or when taxes are due. So it's likely that we're going to see the TGA begin to rise by about $100 to $200 billion, and that will push us probably back somewhere close to about $600 billion. If we just take a look at some of the other periods of time, so this was April of 2025. We got a big increase in the TGA, a big increase in April of 24. This was June of 24. The TGA increased by about 130 billion. September of 24, another 100 billion. So it's possible that by the time we get said and done, here's 2023. We had 150 billion increase during that month. This was 22. We had a big increase. So there tends to be a pretty big increase in the TGA around that time, around the time of taxes. And that's not really unusual, and we would expect that to happen. The thing is that this is going to affect reserve balances. Reserve balances have moved up quite a bit in recent weeks. This is a modified version of such, but again, generally speaking, these have moved up quite a bit as the TGA has been drained. But what also is very important is that we've not only seen reserve balances and liquidity from the Fed increase, we've not only seen the liquidity from the Fed increase, but that's translated into a higher margin in the equity market. And of course, when you have extra liquidity, that helps to lead the rebound. So if we were expecting to see the TGA begin to move up this week, we should expect to see the reserve balances actually begin to come down a little bit, and that could potentially drain some liquidity from the marketplace as well. In addition, what we've really seen quite a bit is this excess liquidity push down SOFR rates. The overnight SOFR rate is around 428. This is a number that comes out every morning, and when it's really low, it suggests that there's basically ample liquidity in the system. And if you notice, this number at the beginning of May was up at around 440 or so, and then it started coming down in May as liquidity conditions began to ease. It tightens up into the end of the month. So we have a couple of things going on now as we're heading into the end of the quarter. First, we're going to get tax receipts coming in at the end of this week, and that's going to potentially drain and reduce some reserve balances that are out there. But also, we're going into quarter end, and typically what we see into quarter end is we see liquidity get drained out of the marketplace. We see the SOFR rate begin to move higher, and as the SOFR rate begins to move higher, it's an indication of less liquidity in the market. You can see this really took place starting around March 20th, and we went from around 430 in SOFR all the way back up to around 441. And it really didn't loosen up until about the middle of April, and then we started to see liquidity ease again. And so this is important because obviously, if the overnight funding rate begins to move higher, and you start getting less reserve balances, there's less reserve balances in the marketplace, that could push liquidity, put downward pressure on liquidity over the next 2 weeks. and that could result in some downward pressures in equity prices. And I mean, if you go back and you look at the chart of the S&P, for example, we had the bottom, took place a little bit after, the tax reporting season. So here was April 15th. And then a little bit after that, the 21st was really the bottom, and that was the OPEX date. We also have an OPEX date this week, and then, of course, we got the rebound. So it's quite possible that heading into the next couple of weeks, as we have this tax date coming up, as we go into quarter end, it could potentially push upward pressure on rates, on overnight rates, and that could put downward pressure on the amount of liquidity we've seen in the marketplace. And I mean, clearly, when you look at this chart, it clearly demonstrates that there was a big liquidity surge in the market over the last couple of weeks as margin balances rose pretty dramatically, as this shows. So again, we're going to want to pay attention to basically the SOFR rate that comes every day. If that comes in and it starts creeping up every day, it's really telling you that the liquidity in the market is becoming tighter. And that's really the key. You can get SOFR right on TradingView. It doesn't update instantly, but it usually updates mid-morning. Or you can just go to the New York Fed website and find it there. They put it out every day at 8 a.m. Again, here's your SOFR rate. And basically, again, you can see we're trading. SOFR has been trading really at the very low end of the range. And so we should expect to see SOFR probably moving back up towards this 440 area by the time we get to quarter end on June 30th. And I would expect that to happen really over the next 2 weeks. And so that would probably tell us that we should expect more volatility in the equity market as liquidity is withdrawn. And that would probably mean that we could see some further downward pressure on equity prices as we go through the next couple of weeks. Maybe we even get all the way down and fill the gap that was created at 56.60 or so. That is certainly a possibility. Anyway, I hope you found this video helpful. Please remember to subscribe to this channel, and I'll see you again soon. Bye.